Hey there, everyone. Happy Thursday. This is January 4th, 2024, and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. The technical analysis toolkit is really a way to quantify investor psychology. At least that's what I've always tended to think of it as, right? Thinking about buying and selling, what motivates those buying and selling decisions by millions of individual investors and institutions that represent their assets. At the end of the day, an analysis of price is really analyzing how investors are voting with their capital, not what they're thinking, not what they say they might be thinking, but what they're actually doing with their assets. We have a great guest today, Jeff Hughes of JWH Investments. Always really helpful thinking about some longer term trends, looking at really the relationship between sentiment and breadth and momentum, all of which I think are really crucial here as we begin a new year, as we think about some of the seasonal weakness that may be playing out so far in the first trading week of the year, and what we might need to think about going forward. Jeff was part of our Charting Forward 2024 market outlook that we had before the holidays kicked off. And as we talked about those longer term trends, it's interesting to see how quickly the market has fluctuated here in the new year, giving back some of those gains from the fourth quarter. We'll see what remains for the rest of the first quarter. But let's get to what happened today as we start with our market recap. Before we get to the chart of the S&P and some of the other leading indexes, I do want to talk to you about a poll that we asked recently. We asked you all, what will the S&P 500's total return be in 2024? I thought this was an interesting one. I'm very keen to hear what today's guest, Jeff, will say about this poll. You'll look at the responses, 81%, it looks like, saying a positive year. Between 0 and 10%, over 10%, actually, the most common answer with about 41% of the vote. Only 14% saying we get over a 10% loss this year. What's interesting is if you look at the trend, I mean, the reality is the markets over time are up more than they're down, but there are some career-busting moves within the context of this long-term bull experience that I think equities have played out. And if you think about what happens in 2024, even if we do end up being up, 5-10% for the course of 2024, there can be some massive fluctuations. And I think what's great about technical analysis, it's not just about the finish line, right? It's not just about what might happen 6, 12 months, 6, 12 years, whatever your finish line is for the methodology or for the approach to the mandate that you have for a particular portfolio or for your particular account. It's all about that path, right? Path matters, and thinking about the trajectory from point A to point B, thinking about some of those up and down swings. Elliott Wave is one of those toolkits that can help us try to anticipate that. So we'll hear what Jeff has to say about the markets. Overall, let's get to today's action and see how things played out. The S&P down about 1/3% today. The S&P finishing just below 4690. We'll call it 4689 at the close. That's down 1/3% from yesterday. The NASDAQ yet again leading the way lower here, down about 0.6%. That puts the NASDAQ composite just about 14,500. The Dow flat for the day. So we're back to that familiar pattern of 2024, which is growth down, the S&P down, the NASDAQ, of course, down, all dominated by mega cap growth stocks. The Dow, which is a little less dominated by growth, a little more broadly representative of sectors, even though it's a pretty narrow group of 30 stocks, flat for the day. So let's keep that in mind as you look forward. Mid caps and small caps actually flat. So it was the mega cap growth trade, I guess, relatively speaking, that seemed to be weighing on the markets here. The VIX pushing up a little bit, right? So the VIX is pushing above 14. That's from yesterday into today. So pretty high relative to the last couple of weeks, although I don't know if that doesn't mean a whole lot. We're still in the mid-low teens, right? And so we're in a low volatility environment. When I think about the market going higher in the fourth quarter, we talked at the end of last year about some of those signs of a change of character, right? What would you need to see that would tell you that something different is in fact playing out? And I would say elevated volatility, widening high yield spreads, rates changing, the dollar changing. These are all things that suggest something different, and we may be seeing that with the VIX if we continue higher, pushing up into the upper teens, and 20 is sort of that back of the envelope level I'll be looking for. We're pretty far away from that. Note, by the way, the sell-off we had through the course of the session today. In the late morning, the S&P was actually pushing a little bit higher. Right around lunchtime, we rotated lower. The last half hour, really the last 15 minutes of trading, pretty aggressive to the downside for the S&P. Interest rates a little bit higher than they were yesterday. 10-year yield just below 4%, we'll call it 399. The long bond yield around 414. 5-year point around 397. So, rates for now remaining elevated, I guess, relative to recent standards. If you look at the last couple of years, we're still around 4% on the 10-year, which is higher than we had been. But relative to long-term trends, we are remarkably low. Again, I keep coming back to Ralph Eckenpour telling the story of getting a 10% rate on his mortgage for an apartment in New York, and this was in the early 1980s, if I remember right. He said he hugged his mortgage broker that he had such a great rate at 10%. So, it's all about your frame of reference, right? Based on historical averages, 10-year yield at just below 4% is not too bad. But for a lot of investors where their, sort of frame of reference is the last couple of years, we have sky-high rates, right, with the mortgage rate I saw up in the 6.5–7% range. So keep an eye on rates, and if they would push back higher. We're down below where we were at the peak here last year with the 10-year yield around 5%. Bond prices, of course, coming down when yields are going higher. So the TLT down about 1.5%, that is, and the dollar index flat from Wednesday's close. Looking at commodities, the DBC continued to push lower. So we've talked about that downtrend in commodity prices overall, and certainly in energy prices. Crude oil moving down yet again. Natural gas prices bouncing higher. The UNG was up about 6% today, but crude oil, sort of that main energy benchmark, down yet again. The energy sector right at the bottom of the list, I believe. There it is. You can see gold and silver actually flat. So keep an eye on gold, right? Gold has come off after threatening yet again, sort of pushing above $2,000 up toward $2,100 an ounce. Came off there a little bit. Keep an eye on that gold chart to see if we can pop higher. Today's sort of flat, while a lot of other risk assets were down. And all green on the top 10 cryptocurrencies that we track on our platform. Bitcoin around 44,400, 450, we'll call it, up about 3.7%. Ether prices up over 3% as well, nearing that 2,300 level. Looking at sectors, it was healthcare, financials, industrials, number 1, 2, 3. These are not growth sectors if you're new to investing, or if you're not familiar with these sectors at the top. These are some other things, right? These are more value-oriented sectors pushing to the top. The growthy stuff is down toward the bottom along with energy, but it's more value-oriented sectors. The XLV, healthcare number 1, up 0.5%. Financials number 2, up 0.4%. Industrials number 3, up 1%, 0.1%, that is. On the downside, you have energy lagging behind pretty good, down in another 1.7% for the XLE. Technology and consumer discretionary both down about 0.7%, 0.8% for the day today. So the problem there is there's a lot of market cap represented in those two sectors. The XLC would be another big one as well, and all of those sectors are down. The sectors that are up, there's just a little less of a representation in the S&P and the NASDAQ. Certainly a little bit of a larger representation in the Dow, certainly in terms of financials and industrial. So those sectors hanging in there and outperforming the market means the Dow is going to outperform the S&P, and that's sort of what we've observed today. Let's check in on a daily chart of the S&P 500. So further deterioration here. So the last 5 sessions, we have had a series of lower closes. I don't, off the top of my head, have the numbers where, all right, let's say the S&P closes down 4 straight sessions. What does that tend to mean? But I will tell you what it tends to mean is that the market's going down. It's not going up anymore. And we saw that right at the end of last year, and we saw the S&P making a new high on weaker momentum. It's still overbought there in the last week of the year. This was between Christmas and New Year's, but since then we've rotated lower. And anytime you make a new swing high and then pull back, I always watch the most recent swing low as a short-term measure that can be pretty helpful, right? Just to see, are we holding above the most recent swing low or not? That for the S&P 500 is right around 4,700, and that's that swing low just from the 3rd week in December there. As of today, we actually closed below that level. Yesterday, we traded right down to it. That's on Wednesday's session. Today, on Thursday, we've actually pushed just slightly below it. So, again, an uptrend on whatever time frame is a pattern of higher highs and higher lows. A downtrend is a pattern of lower highs and lower lows. So, watch for when we are unable to hold a recent swing low. In the short term, certainly suggests a bit of a short-term deterioration. Now, let's keep in mind, though, that the bigger picture means there could be some levels to pay attention to. We might talk about a Fibonacci analysis if we have time for it in the market recap, but these shaded areas represent the levels that I am paying attention to in terms of key support if we would have a further deterioration to the downside. S&P 4600 is basically the July high. Getting to that level in November was meaningful. Breaking above that level in December was certainly noteworthy. If we hold that on the way down, I think that's important. And it's not just the chart of the S&P. We can look at a number of names that if you look at those breakouts now that we've broken to a new swing high at the end of last year, when we pull back, that breakout level often is a good sort of initial line in the sand. So 4,600, kind of a sort of a basic level to watch. I'm also looking at this gap in the S&P and the NASDAQ. A lot of other ETFs that we could highlight all have that gap from mid-November. That was on a CPI number from October. The market gapped higher, and I think that also presents a potential level to a look at the 50-day moving average, right, by the way, right in the middle, around 45.30. So some levels to pay attention to. And again, in this sort of environment, it's sort of a bent but not broken. And I guess the question for all of us is, what level would we break for us to get a little bit more defensive? I haven't seen enough to say, okay, this is the end of the world type of move. This still sort of fits in within an overbought market that is sort of pulling back, which makes sense. Extreme upside breadth, which is now becoming alleviated. Let's look for signs that we're breaking key levels of support. That's when we can start to get a little bit more concerned. Now, in the short term, some of the breadth conditions we've referred to continue to deteriorate. This is not updated for today's close just yet. This is as of Wednesday's close, but based on what I've seen with the advanced decline data, expect the McClellan oscillator to go further down. So the McClellan oscillator went above zero the last week in October, right around Halloween. From there, we remained above zero through basically the entirety of November and December. And right at the beginning of this year, we pushed below the zero level. And the green shaded areas show you when the McClellan oscillator is above zero. Those are the bullish swings in price. The red shaded areas are where the McClellan oscillator has gone below zero. You can see that's where the pullbacks have tended to happen. So again, we saw those extreme conditions in December. We're now seeing some initial drawdown off of those highs in last month. And now it's in the McClellan oscillator, one of those suggesting that extreme bullish breadth may be alleviated here. It's not necessarily bullish here for the short term. And again, could not be the end of the world, right? It could be just a short-term pullback. Definitely tells us that we're more likely lower than higher until proven otherwise. Another chart I want to highlight for you is just value versus growth. I was talking to some media outlets earlier today and was asked about growth and value stocks, which you have to remember is in November and really mid-November to December. This is when value sectors actually started to pop a little bit, right? So you saw financial sector names like JP Morgan actually starting to look quite good, actually. JPM looks a lot like a growth stock as opposed to a value stock, as someone mentioned in the comments on this show recently. I would totally agree, right? It looks more like an AI name than a big financial institution, but that is what happened in November and then into December. So this is the ratio of growth over value. And I'm using two ETFs, the IWF representing growth, IWD representing value. You can see from mid-November, and it's worth noting, right, the late October is when the market bottomed out. And on that initial bounce off of the October lows, it was growth really leading the way higher. But from mid-November really to where we're at today, value sectors are outperforming. And if you look at the performance of communication services and technology, not horrible, but certainly not outperforming to the pace that they were earlier in 2023. Healthcare, financials, all popping on a relative basis. And so this ratio really starting to favor value over growth. That would be a very different environment in 2024. Most of 2023, this ratio is going higher. This ratio continues to go lower. I think that's a very different feel and a good warning sign for those of you that are maybe underexposed to those value sectors that could maybe potentially be an opportunity. You know, small caps pulling back here, and small caps are a little more value-y if you look at the sectors that are represented compared to the S&P and the NASDAQ. But from a purely technical perspective, I'm looking at this level on the IWM. That's the Russell 2000 ETF. You can see the August 22 high, the February 23 high, the July 23 high, all line up right around this same range, kind of a 195 to 197 level on the IWM. We gapped right above there in mid-December and pushed higher. So third week in December, when we're getting to the Christmas holiday, small caps looking fantastic, right? Gapping higher, pushing higher. Now we're actually starting to pull back a little bit right to that breakout level. And again, similar to the S&P, right? When we've broken out and then we pull back, do we hold that breakout level? So I think we're right at that point where you have to question whether small caps are sustaining this breakout. Do we find support right around this gap, or do we break further down? And if we break further down, that tells me to expect further corrective sort of behavior from some of those names that you might want to hope we're pushing higher a little bit. On the weekly chart, you can see those highs that I mentioned on the previous chart, but the weekly chart just shows you how sideways small caps have been. shows you how significant that breakout certainly appeared to be. And now that we pull back a little bit, a failed breakout would be, again, sort of a bearish sign for stocks going forward here, certainly in the first quarter, I would imagine. One of the things I used to show on the final bar years ago, and I don't honestly know why I stopped doing it. I guess I just found other things to show everybody. But one of the things we used to do was do the candle glance page for the S&P sectors. Here we're looking at the 11 S&P sectors, and then also the S&P itself in the lower right. So we have communication services, discretionary, and then on through the 11 sectors, the S&P here for reference. So first off, let's keep in mind that pretty much all of these, I'm not finding one that is below its 50-day moving average. So that's not bad, right? That's actually pretty encouraging. But what you look for is you look at some of these breakout charts, and now what's happened since then. We'll start with the XLC, which is, of course, communication services. Here's the breakout level in July. That's the July peak. We retested that peak in October. We gapped above there in mid-November, actually pulled back to the breakout level in December, and then broke higher. So as we go lower, and if we would continue lower, that's kind of a natural place to expect support. The 50-day moving average around 69.40, the most recent swing low around 68.50. That lines up with some of the previous highs around 68.50, 69. So we kind of have a cluster of support, what we call a confluence support, all around that 68.50 to 69.50 range, which, for me tells me we could have a pullback all the way to there and still be within a pretty constructive pattern. We break that, and all of a sudden that's something different. That's what I think, one of those things that differentiates between a short-term pullback and something maybe a little more significant. Technology, kind of a similar idea. You have the high from July. We gapped above that level in mid-November, pulled back here, and then made a new high. Now in the beginning of this year, we're gapping lower and pulling back right around to that breakout range. The resistance from July is around 180. That's just below the 50-day moving average. So same thing, we're approaching that confluence of support there as well. Industrials, of course, not a growth sector, but a little more of a value-oriented sector, but you find a very similar pattern to the XLK. Had a worse sort of performance here going into the October low, but recouped all of those. Same thing, broke above the August high. It actually peaked out in late July, early August. Now we're pulling back a little bit, around 110. That's that breakout level there. We've now broken below the gap from mid-December. So again, a lot of these names now are sectors as we've pulled back. The question is, do they hold those key support levels? Let's talk about two sectors that are actually starting to improve a bit. Here's the XLV. Talk about an outlier, right? As all the other sectors I've just shown you have pulled back so far to start the year. And again, we're only a couple sessions into the new year, so let's not draw too many long-term conclusions, but let's make note of the fact that healthcare looks a little bit different, right? While these other sectors have pulled back, healthcare actually pushing to the upside, making a new 52-week high. Another one I would show you would be, actually, no, let's leave right here. We'll finish with two individual names. I want to point out BSX, Boston Scientific, right? When you look at the healthcare sector, and I would encourage you, when you find a sector that's starting to work, when you find a sector that's starting to outperform, use our scanning engine to identify areas of that sector that are really starting to lead. If you look at Boston Scientific, you'll find resistance in June, August, September. You can see we broke above those levels in the fourth quarter, now gapping higher and pushing higher. That's a pretty decent base and a nice breakout. I think that's a strong chart until proven otherwise. Stryker, same group, by the way, same sector, same group, medical equipment. This is one that it has not quite broken out yet, but you can see testing resistance. Again, while other things are sort of drawing down, this is actually still testing those previous basing patterns. So certain sectors like healthcare actually have been in a base and now starting to break out. That could be where the opportunities are when you find other areas of the market starting to struggle a little bit. There's our market recap for today. Again, thanks so much for all your suggestions and your feedback on the show as we continue on. We're going to bring on today's guest, Jeff Huge, in a few moments. Before we get there, a couple of quick announcements. First off, our mailbag. Would love to hear from you. I mentioned the mailbag was empty. We've got some great questions here in the last couple days. Keep them coming. We're looking to do an all mailbag episode on Friday. We'll hope to do those regularly going forward as well. Our email, that's the best way to get your questions in front of us, thefinalbar@stockcharts.com. On X, just tag us in a comment at FinalBarSCTV. On our YouTube channel, of course, just put a comment below the video you're watching. Drop it in the chat if there's a live chat going, and we'd love to hear your questions. Hope to feature one of your questions in our next mailbag segment. Also, to let you guys know, this is going to be our last live broadcast here for now. We're going to be going back to recording things a little bit ahead of time. We're really excited to have some deeper conversations with guests, think about the formatting of the show. So if you have suggestions on what we could do to make this show more helpful to you, please let us know. But we'll be updating you with more information very, very soon. But starting on Monday, look for it to be posted after the close. Before you go to sleep, make sure you check in on the final bar for sure. I want to bring on today's guest, Jeff Huge. Jeff is the Chief Investment Officer of JWH Investment Partners, coming to us live from Minneapolis, Minnesota. Jeff, Happy New Year. How are you?
I am well, Dave. Happy New Year to you. And I'm really honored to be on the last live broadcast.
Here we're finishing strong, Jeff. You're one of our favorite guests, and really appreciate your insights as always, helping us try to put things into perspective. And I learned a lot about technical analysis, thinking about opportunity and thinking about risk. And I love how you often sort of describe those different ways to use the technical toolkit. Let's get to your charts because I know we have a couple to start with. When you look back at 2023, what are your takeaways here to start off with?
2023 was either a year when you owned the Magnificent Seven or you didn't. And if you owned them, you held on for dear life, because really that's what made the difference. The mean return of a stock in the S&P 500 was only 11.5% last year, and that's observable in the equal weight index of the S&P. All the big returns were from the mega cap techs, and that mostly occurred early in the year, the first 3 quarters of the year, and then they kind of held their ground. And it's observable in the NASDAQ and the S&P cap weight index. But everything from small cap, micro cap, mid cap, NYSE, so broad market exposure, the Dow comp. These were all up somewhere between around roughly 10 to 14%. Pretty pedestrian returns, relatively speaking. Another interesting fact is about 70% of the constituents of the S&P underperformed the benchmark index, and about a third finished the year in negative territory. So, not an epic bull market by any stretch, unless you own those 7 titans, right?
It's funny, and you and I both spent a lot of time working with professional money managers trying to beat the S&P 500. It's not a particularly easy benchmark to beat, and last year I feel like yet again a really tough one. If most stocks are struggling to do it, it's a tough market to outperform. Let's keep going with chart number 2. Talking a little bit about the sentiment, really.
Yeah, sentiment speaks to the neighborhood in which we're operating in today. And, back in late October, we saw most of the major sentiment gauges really in bombed out territory, bear market extreme attitudes, right? Well, it's quite the opposite today. In fact, as we come into the new year, you can look at the top frame, and that represents the National Association of Active Investment Managers, the NAME Exposure Index. And we're actually leveraged today at over 102%, exceeding the level that existed back in July, and nearly matching the level that existed at the all-time record highs. So professional investors are basically all in at this point. Conversely, if we take a look at the individual investors at the bottom frame, relative to new highs in the S&P 500, we now see individual investor optimism starting to roll over aggressively from a 3-year high. The last 2 weeks, we saw the bull-bear spread in the AAII survey come in at 32%. Anytime you get above 30, it typically coincides with at least a minor top in stocks. In this case, I think it's a much more significant top that we need to be concerned about. And one measure that isn't in the chart is looking at the Investors Intelligence Advisors survey. We just saw a new 2.5-year high, the highest we've seen since, I believe, November of 2021. Came in, I believe, at 76.9%, looking at bulls divided by bulls plus bears.
The word euphoric came into my mind as you were showing this chart and talking through some of these levels, Jeff. This next chart, I'm really glad you brought it. You were on part of our Charting Forward 2024 panel, which, again, thanks again for doing that. And one of the indicators you mentioned was this moving balance indicator. Talk to us about this next chart.
Yeah, the moving balance indicator, or the MBI as we call it, was developed by a guy named Humphrey Lloyd back in the 1960s. He detailed it in a book called Moving Balance Systems in 1976. Not a bestseller, okay? Very few people are familiar with how to use this. The way we use it is this. You're looking at the upper frame showing kind of the daily end of day MBI reading. And what this is a measure of the momentum of breadth. And when it gets super overbought to about 90%, it usually indicates a kickoff of a new leg of a bull market, right? And we would suggest that over the last, say 5 years, we've seen pretty consistent performance. The kickoff in 2019, the kickoff mid-year in 2020 following the pandemic crash, a follow-through kickoff in early 2021 when they discovered a vaccine for COVID, and then again, following the lows that we saw in October of 2022. These were all good indications that the market was ready to surge higher, right? And the flip side is when we get down below 30%, it tends to indicate a bottoming out. A lot of people like to look at the Zweig bread thrust, but I'd say the Zweig bread thrust, for all the benefits that it provides, it misses a lot of the action, right? It didn't signal anything in 2020 or 2021, and it didn't quite catch the bottom. We did get a couple of signals this year, and those were good signals, right? But they were unconfirmed by the MBI. And I've been saying, hey, the MBI's MIA right now. And so I don't think this is a durable rally because the MBI has basically marked the surge of every new durable rally. And we have not seen that. Now, it could change, but so far we haven't seen it. So I'm a little bit dubious with respect to the durability of the current move that we've seen.
Super helpful, and thanks for comparing those two and describing them. That was excellent, Jeff. Your next chart really addresses, one of the issues we've talked about on the show, divergences, right? The market moving higher on weaker momentum. Talk to us about your take here going into the beginning of the new year here.
Yeah, so we're showing the weekly chart of the S&P 500 versus two different measures of momentum. One is the momentum deviation above or below the 200-day moving average, and the other is the 13-week rate of change on the bottom. Both of those measures are deviating negatively or diverging negatively relative to price. Now, negative divergences can also be observed in the daily and the monthly on most indexes that have moved to new highs, for example, in the Dow and in the NASDAQ. And I'd also point out that there's also a major Dow theory non-confirmation that remains intact at this point. So all of these indicators are suggesting that we're not getting confirmation of these new highs in the market. And we haven't even made a new high necessarily in the S&P on a closing basis or on a total return basis, yes, but that has been unconfirmed by momentum at this point. And that raises the possibility that we are at the point of a rollover in trend. And we've been saying that we think this is going to be a double top for the S&P 500, and the momentum indicator, the breadth indicator, and the sentiment indicators today are confirming our suspicions so far.
When the market's going higher, to get to your next, Jeff, the valuations obviously tend to follow. We're raising the numerator in those ratios. What are the valuations telling you here, relative to what we've talked about so far?
Again, related to the neighborhood in which we're operating in, valuations are in the 10th or top decile of historic valuations. And high valuations tend to cap upside potential. They're not great timing measures necessarily, although my old boss, Steve Leuthold, might say the opposite. He always thought the PE was a great timing measure at extremes, and they are. But, we're in the 10th decile of valuations. And what happens from that top decile is forward 10-year average annual gains tend to be very muted. The Leuthold group calculates those every single year, and they're currently looking at forward 10-year returns at like 3.25% going forward from these levels. So I'm very concerned. Price to sales at 2.6 is above where it was back in 2000 during the dot-com bubble. And with respect to inflation adjusted and normalized margins on the PE ratio, we're in the lower 30s now, which again is in the top decile of historic valuation. So something to be concerned about, I think, on a go-forward basis.
Jeff, on the charting forward special, our market outlook special at year end, we just got to this at the end of it, and I'd love to spend a minute on this one as well. This is looking at W. DeGan, whose work I know you've followed and spoken to. What does it tell us about the long-term cycle? Because this is a pattern that was identified decades and decades ago, right?
Yeah, he first published this financial timetable chart back in 1909, and it's really based on the 18.6-year lunar declination cycle. A lot of people know Gann for his work with harmonics and geometry, but he actually was an astrologist. He looked at all these astrological relationships, but we can't fault him for that. For whatever reason, there is a cycle that falls to this, whether it's the gravitational force of the moon and the tides and bipolarism in human beings and biochemical reaction to increases in magnetic energy. I don't know the reason, but it's there, right? And so this cycle has actually identified numerous crashes in the past: the crash of '87, the tech wreck, the financial crisis in 2008. All of these were highlighted in this chart. And what it's saying right now is that the period beginning in 2024 through 2027 is a period of major panic, potential crash, and 4 years of downward stock prices before we find a major low, I believe in 2027 is according to Gann's work.
Let's get to the final chart here. We're a great setup for the value line geometric, and we should note this is a weekly chart of the value line geometric index, not the S&P. But what's your wave count here, given the conditions at end of 2023?
Well, we think that the market topped at a major super cycle degree back in 2022, and since that time we've been putting in a corrective waveform, which are typically 3 waves, A, B, C. And so the first wave was a motive wave, an impulse pattern. We count it 1, 2, 3, 4, 5, and that got us into the lows in October of 2022. Since that time, we've traced out a choppy lateral corrective waveform. I'm not 100% sure how to count it. It's either a double zigzag or an expanded flat. Either way, it's a corrective waveform. And if it's topped, then the next move is to the downside. If it hasn't, it will probably top very, very soon with not much further upside. We don't think it'll exceed the 61.8% retracement, which is just a few percentage points higher. But from that point, Dave, we think wave C down should be a dramatic decline and carry the index down to potentially new bear market lows below even what we saw back in 2020. So that's kind of a working hypothesis. And when we look at this index, because of the way it's constructed, it's equally weighted. It's the top 1,700 stocks in the United States. It includes Apple and Microsoft, but it also includes a lot of mid caps and small caps. It really represents the stock market. And one thing that I'll point out is that the 200-day moving average is trading below the 200-week moving averages. A lot of traditional technicians would call that a major sell signal.
Really interesting. You're giving me a little PTSD on my CMT exam years ago. The running flat pattern was there. It was a big question on that. So anytime I see that pattern, I sweat a little bit. But really well documented. So, with all this in mind, we only have about 30 seconds left, Jeff. But with that in mind, and given some of the downside pressure you see going, how do you position yourself now with that sort of expectation? Is it a wait and see, keep risk on until proven otherwise, or is it the time to get defensive now? How do you approach that?
I think you're better off getting defensive in front of it. We've been recommending our subscribers to our newsletter, hugeinsights.substack.com. You can check it out if you want. We think a heavy allocation to cash and gold is probably going to pay pretty strong dividends next year. We would minimize net equity exposure, and we tend to be long-short investors. So, we find enough longs and enough shorts to create a market neutral exposure to equities, and are able to eke out a nice return doing that.
Jeff, it's a pleasure as always. Thanks again for being part of our year-end charting forward special. Thanks for adding some of the details on the charts today. Be well, stay safe there in Minneapolis. We'll look forward to other conversations this year.
Thanks, Dave. Really appreciate being on the show today.
That's Jeff Hughes. Jeff's the Chief Investment Officer at JWH Investment Partners. Really interesting, and again, I cannot disagree certainly with his interpretation of breadth, momentum, trend, and all of those measures. I mean, just thinking about the evidence the market provides back to him. What I love about sort of looking at those final charts, right? The cycle. Let's say the overall pattern is more negative, but you can also think about how the charts, that first group of charts, how they evolve and actually track the movement and see how the different scenarios may be playing out there. That was a great complete meal there of technical analysis by Jeff Huge of JWH Investment Partners. Hugeinsights.substack.com was the website he mentioned for his retail-oriented newsletter. We've got to wrap the show, folks, and go to the 3 and 3. 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. When I'm thinking about this initial drop in 2024, again, I think it's still early to certainly declare that the market is in a downtrend, but thinking about downside potential, thinking about what levels you would need to consider to really be aggressive about changing positioning, I think is very, very astute. And I think, well-informed investors take those levels, take those lines in the sand to heart and focus on where they need to make proper precautions in their portfolio. And I'm looking at the S&P and thinking of the rally off of the October low. I just did a quick Fibonacci analysis, taking the October low from the fourth quarter, taking the high that we achieved right before year end. Now that we've sold off a little bit, 38.2% of the way down would be right around 45.30. That actually is just below the July high, but right at that late August, sort of early September, kind of Labor Day peak. So keep an eye on that. Again, what I'm seeing on a lot of these charts is there's certainly plenty of room for a lot of these things that have had such strong gains to come down before things really get worrisome on the charts themselves, right? Until we break levels. But keep an attention on those levels. That's a great place to use the alerts functionality on StockCharts, by the way, to make sure you don't miss a breakdown in an area of the world that you want to pay attention to. Chart number 2, looking at small caps. Large over small was the story, one of the stories in 2024. If you think about growth versus value, all different styles, none of that was as important as the largest names dominating the smallest names. That was a key story. But at the end of the year, you started to see value stocks do a little better. You started to see small caps rally a little bit. And the IWM indeed broke above this basing pattern, but it's starting to feel a little bit more like a failed breakout, right? The question is, do we hold that breakout level on a pullback? And the daily, weekly charts of the Russell 2000 ETF are starting to get me thinking that may not be the case. Finally, we finished the show on a high note. There are stocks going higher, and I think that's one thing that I've learned through the course of my career. During extended bullish phases and extended bearish phases, there are always those barbells, right? The stocks that are really working and really not. I'm noting areas of the market like financials and healthcare that have not been coming up on my radar too much, now starting to come back up. Here's BSX making a new 52-week high today. This is Amgen and the biotech group making a 52-week high again this week as well. So there are names that are breaking out. Amgen featuring what I would probably describe as a cup and handle breakout pattern. That usually happens early on in an advance, but keep an eye on those breakout levels and any sort of pullback. I think that's an important level to watch, and certainly some clear levels of potential support for some of those key names in healthcare. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the Final Bar. A special thank you to Jeff Huge of JWH Investment Partners joining us from Minneapolis. Don't forget to like this video, subscribe to our channel here. We're close to 100,000 subscribers. A lot of good things in store for the Final Bar as we evolve this show in 2024, but we're looking forward to you being a part of that journey. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.